Hi, hello, good morning, good evening, friends. Welcome to Super 25 2.0, India's largest online stock traders conference. Friends, today we are on the fifth session of the conference series with an interesting topic called HIT system, which officially stands for Harmonic Patterns, Ichimoku Signals, and Trading Psychology and Risk Management System. We have Mr. Dinesh Nagpal, who is a trader, investor, trainer, who has spent a significant amount of time in the financial markets. He has extensively spent time on Ichimoku Kinko-hyo strategies, and his main area of focus is Ichimoku and Harmonic series. Mr. Dinesh, I think you are speaking in our program for the second time.
Yes, sir. Yeah.
It's a great pleasure to have you on board, sir. Thank you very much
Thank you.
for
Pleasure is
being with
mine.
us today,
Thank you
and
for
we
having me over.
extend our warm welcome to you.
Thank you. Thank you very much.
Go ahead, sir. The stage is yours.
Yeah. Okay. So hello everyone, and welcome to this session of Super 25 with me. I'm going to be speaking about, like Ashok sir said, on harmonic patterns, Ichimoku, trading psychology. But before I get there, just a little bit about me. Born and brought up in Kolkata. I've been in the market since '87. What started off initially with IPOs and listening to a lot of our colleagues, our elders, and all that out of college, getting into college, business meetings and all that. This company is looking good. That company, just at that time, when the Harshad Mehta era initially was starting and people had started building interest in the market. Otherwise, it was a very, very small, isolated market among a particular spectrum. Few people would be there. It was a taboo to be in the market, and which till current date actually is to a lot of people. So in a lot of families. And then from there started investing. Then we saw the Harshad Mehta era, saw the ketanparak.com bubble also and all. But from 2006, left the family business, became a full-time trader come investor. It was only in 2019 that I decided that I will share my knowledge and I'll start teaching on various topics. So among them primarily being harmonic trading patterns, Ichimoku multi-time frame signals, which is a Japanese study. Harmonics is pure Fibonacci, and trading psychology, risk management. Now, why trading psychology and risk management, and why not say option data or Elliott wave or RSI or any other topic? Is because in particularly in our country, with the new generation, especially the millennials and all who are now digitally more inclined, more faster, and we have a lot of softwares which are now pushing us a lot of new genre who are starting becoming entrepreneurs and traders or investors are they are only focusing on the analysis part of fundamentals either or technical, but nobody's trying to get the trading discipline into them. So, in a rosy market, like for right now, instance, small caps and mid caps are hitting the roof. Every second day, we have a small cap or a mid cap doing a 5% move, a 10% move like that. So these days don't happen on regular basis. They take times. So none of the people who joined the market last year, that is in the COVID crash, have seen a correction actually. They don't know what a correction looks like. For instance, the mid cap and small cap market corrected for 2 years from 2018 February on the date where the late Finance Minister Arun Jaitley announced long-term capital gains tax. That was the peak of mid-cap markets and small caps, and it bottomed out on March 23rd on the COVID lockdown day. So that's 2 years where you had no escape from your stock. If you were going to try to sell a quantity of 1,000 shares of a small cap, you would only see lower circuit on your screen. So it's something like that. So psychology, so when to enter the market, how to control your emotions, because it's the only business in the world where you are constantly seeing your income, your loss running in your screen. No other business in the world, no other job in the world will have you constantly looking at your income. So even if you are in a business, say, of manufacturing or of business of wholesale trading, etc., it's a process, right? You are making a product or you're buying something and you're selling something. End of the month, end of the quarter, your chartered accountant, your accounting team, your software you use tells you you made so much profit this month or this quarter or this half yearly or this year. You don't monitor it on a daily basis. But in stock markets, especially from the derivative trading point of view, and with all the what do you call apps which are there in the world with every stockbroker today, your M2M is flashing on your screen, tick by tick, how much money you are making, and that is something which plays with you. It plays havoc on you. It can play with your greed. It can play with your fear. So this is the most underrated issue. Very few people talk about it. Very few people many preach about it, but very few practice it. So I try to mentor and train the newcomers or those who have been hit on this matter, that how if you want to be successful in trading, not just for a day or a week or something, on a long basis, even in investing. If you go by the Warren Buffett principle, you need a lot of discipline. It's not for someone who doesn't have discipline. So I try to understand the psyche of the person, and then try to take that person, identify on herself or himself on which way the person should be trading and all that. What suits that person. Everybody cannot be an intraday trader, and uh, everybody cannot be positional because of lack of funds. So you have to sign them. And the other part is risk management. Uh, when to be aggressive in the market, when to be defensive, and when to stay out. That totally depends on the kind of money exposure you can manage, which is again a part of discipline. Now, how you manage. There are some traders who are very good with derivative, and some will panic with even one lot of bank nifty or nifty option also. Forget future. So risk management tools are very important. You have to respect them, you have to follow them. It's nothing rocket science or anything. It is basic simple mathematics which goes around the way. So I'll start with harmonic patterns first with you all. So these patterns have been there from a very long time. Harmonics was discovered by Leonardo de Casa, who's more popularly known by his name Fibonacci. And Fibonacci is something which is there from uh, the seven wonders of the world. It's there in the pyramids. It's there in a leaf which you pick up. It's there in a rose petal. Everything has a Fibonacci ratio working on it. So it is only in the in the turn of the 20th century that people started talking about Fibonacci ratio in stock markets and how to use it. Elliott wave is one of the biggest examples of Fibonacci, where it works brilliantly. And then came 𝐸 who's the first man who actually spoke about uh, harmonic patterns, through his market geometry. And there is one pattern which is dedicated to him called the Gartley pattern. And then there is Bryce Gilmore. And then came many other authors after that who have been speaking about harmonic patterns and all that. Why do these things ever? So from a total layman's point of view, that why, especially someone who's not from a technical analysis background and all that, prices never go one way, non-stop. They have their own cycle, they have their own behavior. They will go up, they will come down, again go up, again come down, and they'll make a certain kind of pattern or structure out of it. So harmonic pattern picks up these structures, these patterns, using Fibonacci ratios, and sets out that this will be a completion of a pattern, and now we will see a reversal in it, whether bullish or bearish accordingly. So like I said, it's purely derived out of Fibonacci, but at the same time, we don't look at every Fibonacci number. Every harmonics has certain specific sets of Fibonacci numbers. That too, they have to come at fixed alignment points. Otherwise, it's not an acceptable pattern. We let the stock go. We let the trend continue the way it is running. We don't tamper. So it's properly set out, more like an algo or something like that, a proper Excel, and it moves in that smooth direction, of whichever pattern works out. And they work in all time frames, whether you are a intraday scalper, whether you are a BTST trader, whether you are a positional trader, whether you are an investor, whether you are trading commodities, whether you are trading currencies, whether you are trading equities, and now the latest, whether you are trading cryptos. They work in everything. It works in everything. So there are various patterns, around 30 patterns are there, but the most successful, most regularly found patterns are there are 15, 16 patterns which have over the last 20 years been found to have the highest statistical uh, uh, success ratios. So one of them is this 𝐶 pattern out here on your screen. So they are purely based, like I said, on Fibonacci ratio. So here we have a pattern where this is the line of the fall, first leg down, pull back. Like I said, prices never do one-way moves. Pull back, next leg down, turns around from here. So this is one pattern which is completed. So there's a turnaround. Now, for the 𝐶 pattern, we needed the price to go and take above this line out here to trigger. So once that trigger occurred, we go for a long in that, which has a set ratio out here, sitting out here. It gives us a target out here. So now it's not necessary that every pattern will be successful. There will be patterns which fail. So based on that, this pattern, 𝐶 pattern, which had a trigger out here, it has a stop loss out here. So at 510, it's a buy with a stop loss of 470 for a target of 570. So a 1:2 ratio, which is quite decent enough from a buy point of view. So a 𝐶 trigger, and then the trade takes off. Now, how do I trail this? I run a trend line and I can take it all the way. If I'm not comfortable with trend lines, I can take a moving average and move it with it, move it. Sometimes it's not necessary that a stock will complete its target. It can complete its it can do an abrupt end and turn around from there, or it could fail. So for the failure, we already had a level mark. Now what happens if supposing it stops somewhere here at 550 or at a 535 or a 560? So we use a moving average, or you can use any other indicator you want. And if you're not into indicators and all that, just draw a trend line. Since this was in daily, I would go down to hourly and draw a trend line all the way, trying to catch the pattern. Now why do I draw a trend line? Simple reason, because the stock is going on making higher highs and higher lows, higher highs and higher lows. So I would use the swings of each and every higher high, higher low for my trail stop loss till my target is completed out here. So like this, there are several patterns which I focus on, which I tweet about, which I train about. So like Gartley is there, Bat is there, Butterfly is there, Date Crab is there, Crab is there, Cipher, All Shark, Shark, AB equal to CD, alternate AB equal to CD, 𝐶 pattern, Dragon pattern, 5O pattern. That's the bullish one. Now this is the bearish one. Tata Chemical out here. This is a Tata Chemical stock on the hourly. It has a bearish butterfly. It's an extended butterfly. It should have stopped out here, but it tended to push it up a bit more because of the ratio. The ratio for a butterfly is an XB of 78 and a XD of 127 out here. But this one stretched a bit more, did not negate the pattern, and then started the turnaround. Now, what is the target? Now, remember this, that harmonic patterns are all about reversal. Out of the 16 patterns which I cover, 13 patterns are all about reversal. Only the seahorse, the dragon, and the 5O are patterns which we are actually trading with the trend. The rest of the patterns talk about exhaustion, oversold in the case of selling, exhaustion overbought in the case of selling, and oversold in the case of a buying. So bullish, bearish. So in the case of the bearish one, like this one out here, we have a mark level out here, we have a stop loss out here, we wait for a turnaround out here, a bear candle, a red candle, or a divergence or something like that, and then we take the trade. Now what is our target? Now while harmonics is a all about reversal at certain ratios, at certain points in a pattern. They don't give us fixed targets. They give us a range of targets. So in the range of target is from point C to point D. We are looking at a 38, 50, 62% retracement. So these are our targets out here, and other harmonic patterns as they will emerge out of the turnaround in the case of this example out here. Now, the other part about harmonic patterns is that very few studies in the world give you a early reversal, whether it is bullish, whether it is bearish, whether it is in a higher time frame, lower time frame, uh, commodity, index, stocks, whichever. Very few studies can match up to the level of reversal alerts which harmonics can give. Elliott wave can give you, GAN can give you. None of the indicator studies. Now again, I'll use the word indicators are something like RSI or moving average or Ichimoku for that matter, or MACD or ADX or Bollinger Bands, or name the indicator which is based on data, will give you a signal so fast, or even PNL. They will give you a signal no buy. They will give you a signal from buy to mild buy to that. They will not give you a sell signal like what a Elliott wave or a harmonics can give you, because they are based on Fibonacci ratio. They do not depend on the moving averages or other kinds of average data. So at the advantage is that it is the fastest reversal. Now everything cannot be same, right? We have to be balanced on some side or the other. While that is the advantage which harmonics has, the disadvantage is that the chances of a failure of the pattern, number one, and number two, the possibility of reversal targets. We can't give you an accurate target that this is where the price will go. So in harmonics, like I said, now coming to the first part, the possibility of failure of a pattern. Now, when there is a failure of a pattern, it will go and breach on the upside. Now, from just as an analyst for the hang of it, I can tell you that short a stock at 835 with a stop loss of 860, where the pattern gets negated. So that's at 25 rupees